So thank you, Howard, Howard Lee, I'll always call you Howard Lee, for being our guest investor today. Do you want to talk a little bit about your background? Do you want to have people introduce themselves so we know who's in the room? It's up to you.
I'd rather have the latter. Let me have a little sense of who's here. And
okay. So I'm just going to go down the list. Abby. Oh, Abby, not the other Abby, not Abby Sugar. We have two Abbys in a row. Oh, I don't know if Abby is.
But you're on mute, Abby.
Oh.
You have to unmute.
Here we go. Hi, I am Abby Ludowise, and I am working with a partner on a home hygiene brand that makes a luxurious experience of well-being. We're kind of creating a ritual as well as a product, so it's a lot of fun.
Oh, thank you. Other Abby. Abby Sugar.
I knew that was coming. Thank you, Bonnie. It's always the ABBs that come first. It's great to be here. Thanks for having all of us here, Bonnie, and being here, Howard. My name is Abby Sugar, and I am the founder and CEO of Playout Apparel, which is a digitally native, omnichannel growth-focused streetwear and underwear brand that is building the future of inclusive fashion through a new gender equal, values-driven shopping ecosystem. So I always say that we do not have men's or women's sections of our website. We offer clothing to help people shop their authentic selves while supporting their values with gender expression affirming apparel in limited edition designs and with an inclusive shopping experience. It's Pride Month, so I'm going to say Happy Pride because I get to now. And also I am currently raising our pre-seed fund and our first pre-seed investor raise. And Andy Dunn, the founder of Bonobos, is one of our investors. So really excited with his support.
Oh, thank you. We do have to keep them short because we have a lot of people. Thank you, Abby. Andrea, my friend Andrea Liu. Oh, Andrea, you're muted. Oh, she's still muted. Well, I'll come back to her. Javi, whose name I always mispronounce, and I apologize.
No problem, Bonnie. It's Xavi, but that's totally fine. Always the wrong choice. No problem at all. Hey, everyone. My name is Xavi. I'm the co-founder of Vivo. Vivo is trying to reinvent the mailbox for sales and customer success folks. We're taking away the clutter and making it easy and making sure that salespeople never miss important emails again. Thank you.
Oh, thank you. Adrian Stern, welcome back.
Yes, can you guys hear me?
Yes.
Yeah, sorry, I'm moving around, so I'll be without the video today. But great to be back with all of you. So my name's Adrian. I'm the co-founder and CEO of Reveal, and we're automating the admin work and paperwork around creating content. Anything from copyright to contracts to collecting creator credits. Yeah, been piloting in the music industry with some record labels and Grammy nominated producers, and excited to learn from all you guys.
Oh, thank you. David Robeson, who is also muted right now, so please unmute and introduce yourself. David? Okay, we're going to go to Fiona, and I know that Fiona's not shy. Fiona, you are muted right now, so you want to introduce yourself?
Hi everyone, I'm Fiona. I'm a Brit based in Sydney, Australia, so it's late here, so I've got to keep my voice down. We're building a direct-to-consumer mobile app that's solving the problem of TV show and movie discovery in the streamed space. So a people-powered discovery engine rather than a discovery engine driven by algorithms. Oh. That's me.
Itamar, you're muted right now. Do you want to unmute and introduce yourself?
Yeah, of course. Thank you, Bonnie. My name is Itamar, and I'm building Vibe Together, Tinder for parties. Thank you.
Thank you. Eric LeBeau. Eric, you want to introduce yourself? You have to unmute first. Not only. Oh, I'm sorry, I'm letting people into the waiting room. Trip, you want to introduce yourself?
Certainly, I'm Trip Braden. I do a program with Bonnie every Wednesday on Clubhouse. Currently, I'm working on a social media app, basically in the area of social audio, applying it to the business to business marketplace. So I'm just working on how to put those business cases together on the enterprise. So if anyone has questions, please let me know.
Thank you. Javed.
Hi, I'm Javed. I'm currently working on a rewards loyalty program for local restaurants.
Okay. Juan Ortega.
Hello, everyone. Juan Ortega with Salud Financial. The problem that we're solving is helping to close the wealth gap of the Latino community here in the U.S.
Oh, thank you. Laura Brightson.
Good morning. I'm Laura Brightson. I am New York and Miami based. I have about 20 years of experience in marketing in private equity and venture capital firms for firms like Apex and American Securities. Currently, I have my own VC business and recently had the Coinbase exit and lots of good investments. And I consult to venture capital and private equity firms on their fundraising.
Oh, thank you. Lior.
Yeah, hi. Thank you, Bonnie. I'm Lior Messenger from Israel, actually. I'm the CEO and co-founder of Community. We do an instructional video platform allowing people to ask questions of how-to videos and receive answers.
Claire Chen. Oh, Claire, you're muted. Okay, we'll go on to the next person. Eric, do you want to introduce yourself? Okay, we'll just go through the room.
Hi, hello. Sorry, I just realized I'm muted.
Okay.
Hi, everyone. My name is Claire Chen. Hi. Hello.
Oh, hi.
Can everyone hear me?
Yes.
Happy to join on this pen sections. Let me introduce myself very quick. We are a boutique financial advisory investment consultancy firm, and we sell the private placement, like a private share for the later stage private share before the pre-IPO. We only have a few partners: American, Australian, and the Dutch partner. We work as a team, and we, on the other hand, we also raise funds we help the startup raise funds pretty much for the early stage, but not sort of like pre-seed, seed, Series A. And we are more focused on meaningful impact investing within the SDG and ESG. And I'd love to talk more and happy to learn everyone more about you and see if there are any synergy we can work together. So maybe later on we can catch up through the LinkedIn and send by email, send you a brief. Thanks.
Thank you.
Have a good day.
You too. Mike Rizkawa.
Hi, Bonnie. How are you today?
Good. How are you?
Good. Thank you.
Hi, Mike.
Hi, Howard. How are you doing? It's good to see you again. So my name is Mike Rizkawa. For those of you that don't know me, I'm the co-founder. Sorry?
I know your company. Go ahead. I'm sorry.
Oh, yeah, I'm the co-founder of Snorble, and we are at the nexus between AI, robotics, and health and wellness, where we leverage these elements to create magical experiences to help establish healthy habits for our children and our families. So we raised $1 million in our angel round. We're raising another $2 million right now. We just opened up a round on Monday, and I'm just looking to meet wonderful people that might want to come along on our journey.
Thank you. Tommy. Oh, you're muted, Tommy. Manif.
Hi, good morning, Bonnie and everyone. Good to be here. My name is Munif, and I'm the founder of IntegraPitch. We are a crowdsourced intellectual property platform that is built on Hedera and secured by Hashgraph. We bring together the inventors with CAD and prototype engineers to work on projects for shared ownership.
Thank you. David Robeson, do you want to unmute and introduce yourself? I know some people might be in bad coverage areas.
I'm here.
Oh, okay. Oh, Tommy.
Hey, hey Bonnie. Hey, everyone. Hi, Howard. So I've been in tech and startup for a little over 10 years. Started out a little bit in finance and then moved on to some community work, operations, a few startups, and then transitioned into data science. I really love the deep learning technology. I'm also thinking of starting a dating app, so just getting started on that. Thanks so much.
Thank you. Search at X3EM.
Good morning, guys. I'm Serge at Extreme Mobility Living, and our company is a builder and operator of first in the world 3D printed high-rise buildings. Thank you.
Thank you. Simon Yu.
Good morning, everyone. I'm Simon, the founder of UDay. We're an ed tech app that's reimagining the yearbook industry using daily immersive classroom stories as a way to elevate family engagement and teacher wellness. Thank you.
Thank you. Sophie.
Hi, I'm Sophie. I'm the founder of Reha app, which is an astrology-based dating app for the Indian market. So 90% of Indian couples get their horoscopes and their astrology match before marriage, yet there's not a single platform that does this.
Thank you. Tia.
Hi, Bonnie. Hi, Howard. Good morning. I'm working on entrepreneurship for Generation Z. Right now, I really enjoy the time working with high schools and colleges to help their students succeed.
She's building a platform for colleges, universities, and high schools. It's an entrepreneurship platform for Gen Z. Tim Naughton.
Good morning, everyone. And Bonnie, Howard, thank you for doing this. My name is Tim. I right now run new businesses. So I've been launching a data business, an ads business, an audiences business for the dominant e-commerce company in legal cannabis. Very interesting space, very crazy. I'm actually hanging up my spurs to essentially dive in and help more founders. And I'm going to be doing it on a pro bono basis for anybody with a low income or underrepresented background. So if anybody knows founders that fit the bill that want some free help, I'm raising my hand.
Thank you. It's a hot space right now. So who does? So Eric or David, do you want to introduce yourself? And I know we had. Yes? No? Did I forget anybody else, or did anybody come in late? And oh, George R.
Hi, I apologize. Yeah, my name's George Rosamond from ClearOps. We're a privacy tech security firm, really focused on assessing and rebuilding the whole process of vendor due diligence from the perspective of the buyer. Just my background, I've been in tech for almost 30 years now, primarily Unix, privacy tech, security, and so on. So my co-founder, Caroline, is someone I think some people might know, who's a privacy attorney, startup attorney, been around. And that's about it. Thank you.
Oh, thank you. So Andrew, do you want to introduce yourself? Otherwise, I'll just tell them who you are.
Yeah, sure. Hi, sorry about earlier. I represent a Hong Kong family office. I used to practice law, and for the family, we look at a number of industries, but mostly we look for the disruptive elements of each and every industry in order for us to stroke a check. Alternatively, we'll also come in and operationally get super involved for sweat equity. Yep, good to be here. Thanks, Bonnie. Good to see you.
So Howard, you have the floor.
Well, what would you like me to say? What do you want to hear about?
Well, tell us about your background, how you invest, what you look for. I love your 6 Ps. I remember. I will never forget your 6 Ps.
We'll get there.
Oh,
we'll
good.
get there. So my background: grew up in New York City, went to City College, went off to Cornell for a Ph.D. in operations research and computer science. This was in 1965 when we started, and that was the first year of the computer science department at Cornell. One way to be an expert is to get into a field really early. So when all the problems to be solved are still easy. So I did and got a PhD, taught at Cornell, taught at Caltech for a little bit, went to University of Pennsylvania in '72 and brought the ARPAnet, the machine number 50 on what was then the ARPANET, to Penn. And so I have been on this internet superhighway, if you will, since we were hacking it out of the brush. And there were, we've gone from 50 machines to, I don't know, 5 billion or so, maybe more right now. So it's been pretty good growth. Did a lot of research in the 70s on what in the 70s we called the office of the future. Today we call it the office. The Philadelphia Inquirer said, Dr. Morgan, it's about 1980, Dr. Morgan believes someday executives will type their own emails and there will probably be fewer secretaries. And I was picketed by the Secretaries Association at Penn the next day, unfortunately. But that one we got right. We got a lot of people onto voicemail. I put email into the White House to me in 1978, which later got Ollie North tripped up in the whole Iran-Contra stuff. So had a lot of fun. But in 1982, Jim Simons asked me to help start Renaissance Technology. So I left the university, gave up my tenure, and went into the wonderful world of venture. And have pretty much been there ever since, venture and quant investing, and been there ever since. So after Renaissance, invested on my own for a while, then started Idealab with Bill Gross, which was the first real incubator. In '96, we started lots of companies, many of which were quite successful then, but many more of which failed then because there were only 20 million people on the internet at that point on 56K slow dial-up modems. But we had enough successes, including paid search, something called GoTo, which became Overture, which Google ended up paying $600 million for the patent rights because they were violating our patents on paid search. And then Cars Direct, which became Internet Brands, which now owns all the car sites and WebMD and doctor sites and all sorts of other things, usually profitable internet company. Continued to invest on my own for another few years. So had invested in '92 in a company called Infonautics with a fellow named Josh Koppelman, and then Half.com in '98, which got sold to eBay. And in 2004, Josh said he wanted to start a seed stage fund. There were no such thing as seed stage funds in 2004, so we had the first one. I told Josh in 2004 or 5, I'd give him 10 years, which I did. And in that 10 years, we built First Round into the premier seed stage fund with the first sort of platform, network of founders, all sorts of wonderful things along the way, and invested in hundreds of seed stage companies. First Round Capital 2, which was a 2008 fund, had 70 investments in it. 68 of them returned about 3.5x of the fund, which is quite a respectable performance. But the 69th investment was Uber, which started in our San Francisco office. So we invested in that at a pre-money of $4 million. It's trading higher nowadays on the stock market. And if one of those in a fund isn't enough, the 70th investment was Roblox, which just went public. So that fund returns 35, 40x to our investors. When we first started, Princeton and Yale invested in our fund. They said, we don't know about seed stage. We'd like to learn about it. We like you guys. We're only going to be able to put 20 million in. It won't move our needle at all. When they got their first $500 million out of Uber, they said, gee, this actually helps the endowment. Here's how many kids you're going to put through Princeton and Yale and so on. And so it's a good feeling to know that some of the, and we had some hospital LPs and so on, that we made some good in the world. First round 3, 4, 5, 6, 7, and now in First Round 8 have all done quite well as well. Companies like Flatiron Health, which started in the New York office to try to help cure cancer, and Clover Health, which is Medicare Advantage, which is out there in the public company now through the SPAC sector. But in 2015, it had been 10 years, and I said to Josh, generational transition at funds is hard. I'd like to help make it work better. And so I stepped back. I announced I was stepping back. We created a sort of glide path for First Round partners who were aging out, if you will, of the super early seed stage fund, where you have to really be out and about, every night meeting people. And Eduardo Saverin, who was the Facebook co-founder, nothing like the guy in the movie, by the way, but a really terrific and smart guy, and another fellow in the West Coast, Raj Ganguly, came in and said they were trying to start something and wanted my help. It was a later stage fund based in Singapore and Los Angeles to be global. So we started B Capital Group. It has a partnership with Boston Consulting, BCG, a very tight partnership, in fact. And B Capital Group's first fund was a $360 million fund to invest in the B stage. And we've invested in the US and in Southeast Asia outside of China in that fund. And that fund is doing quite well at this point. It's 5 years in. We started Fund 2, about an $800 million fund a couple of years later, also doing well. We've done a lot of things in the drug discovery area, using AI for drug discovery. We've done things in contract management. We have the hottest company in last mile delivery in Southeast Asia, a company called Ninja Van. When we invested, they were doing 5 million a year. Now they're doing 500 million a year. And to give you an example of how knowing your local market is so important. In the US, when you're going to get a delivery from FedEx or UPS, you get an email from do not reply at fedex.com. And it says, here's your tracking number. And then expects you to go look at the tracking number and look it up and so on. In the various parts of Indonesia and Thailand where addresses are tough, what Ninja Van does is they send you a WhatsApp message that says, I've got a package for you, Bonnie. I want to deliver it tomorrow. How should I best do it? And you interact with a chatbot and say things like, well, don't deliver it before 4 o'clock because my neighbor will steal it. So just wait till I'm home. So come after 4. And by the way, the address says 837, but actually you have to go around the back. There's a yellow door. That's where you should knock and leave it. That's when I'll get it. So they have a 98% success rate on first time delivery, whereas FedEx, DHL, et cetera, in the low 80s out there. And so now they're the carrier of choice for Alibaba, Instacart, Flipkart, Amazon, even Amazon over there. So knowing the local market, and they also do COD, which FedEx won't do in that part of the world. But the way they do FedEx COD is a little different. If FedEx sees they have 5 packages going to the same address, they make sure they're on one truck and they all get delivered at the same time. If Ninja Van sees they have 5 COD iPhones, each worth $600 going to the same address, they make sure there's 5 different drivers. So one driver doesn't have $3,000 in his pocket, which is kind of half of a year's salary income, and gets tempted to abscond with it. They rather give it out to 5 different drivers. So you got to understand your local market and use the AI and the chat features and so on to make the connection with the customer, and the customers love the attention. So that's a slightly different kind of thing we've done there. About last January, we were able to start finally an earlier stage fund. I didn't want to compete with first round for the first 5 years, so we stayed out of the early stage. But we were able to hire Gabe Greenbaum, who had been at Pritzker Ventures, a partner we had at first round, but that I hired a couple of years ago, not at first round, at B Capital, Karen Page, who was employee 7 at Box Group, and was there all the way through the IPO, ran all their marketing, and then ran Europe and a bunch of things. And we've been starting to invest. We have a roughly $200 million fund investing in the early stage ventures in the US and also Southeast Asia outside of China. The reason I say outside of China, China is a different investing world. We now have a 15-person team in China, based in China, mostly native speakers, and they're doing a great job in finding interesting investments. Most of them are not global. Most of them are for the local market. And of course, the China market is big enough that's fine. The Southeast Asia market, when you add Indonesia, Malaysia, the Philippines, and Vietnam, and Thailand, Singapore, and India, is twice as big as the China market. It's 2.6 billion people. And most of them have some smattering of English, and most of them have smartphones, even though they may be elementary smartphones. So it's also a huge market to attack. So we are going to start we have started actually early stage investing out of Bangalore and Jakarta, along with New York, Los Angeles, and San Francisco. So that's kind of what we're doing now. And I spend about a third of my time. My job at B Capital, as Eduardo and Raj said, is to help them make new mistakes and not repeat the mistakes I made building Renaissance and Idealab in first round. And that allowed us to hit the ground running, as it were, with a lot of processes and procedures that we didn't have to sort of relearn over time. And I'm now at a point where I'd like to contribute and help all sorts of companies. So Bonnie referred to what I look for in investments. And what I do tell people, and it is true, is that I look at an investment across what I call the 6 Ps. And if you Google Howard Lee Morgan 6 Ps, you'll find it. So you don't have to take detailed notes now. But anyway, the first P is people. Because one of the things that happens in venture capital is when you invest in somebody, you're likely to be working with them for a decade and maybe more, because it may not just be one company, it may be 2 or 3 along the way. We have some entrepreneurs at first round that have done 5 startups with us, several of which have been successful, not all of which are, and a number who've done 2 or 3 with us. So you want to know that this is a person you're going to be comfortable being around for the next decade or more, and that chemistry is actually important there. Intelligence is important. Integrity is paramount. You want to make sure that you can trust what they tell you and that they will tell you the bad news as well as the good news. In fact, I prefer to hear the bad news first and then the good news. So people come first. Just give me one second here. I don't know. Can I share screen, Bonnie? Do I have the ability to? Let me see if I can share screen here. Share screen. Yes. Okay. I say people come first. If you talk to Scott Adams, who writes the Dilbert column, this is the way that they see it. I don't know if you guys can read that, but I've been saying for years that employees are our most valuable asset. It turns out I was wrong. Money is our most valuable asset. Employees are nice. I'm afraid to ask what came in 8th, carbon paper. And anyway, all the venture capitalists say that people are the most important, and they really are the most important. But in fact, the number 2P is called product. And by product, I also mean the sort of market that you're going after. And in some ways, the market is the most important because it has to be big enough. There are many, many things we see in the venture capital world that will make great businesses, but they'll limit it in scale. And what we want is to invest in businesses that can get to large scale. So there are a lot of businesses that can generate $5 or $10 million a year of profits, which is a great income for somebody and can help them build their fortune over a decade or more. But if they don't keep growing, if they can't get much bigger than that, then they're not as interested to the venture world because you can't capitalize on their future and their future growth. So the market is very, very important. And when you talk to some of the big firms like Kleiner Perkins and those guys, they say the first thing they look at is how big's the market. And there's another reason, because if the market's really big, and if you as an entrepreneur understand that market and you've honed in on some particular piece of that market that you think you can capture, but for whatever reason you haven't gotten it exactly right, the market is so big that you can pivot a little bit and still have a very large market to work in. Whereas if you go into a very small niche market and you don't get it right, there's nowhere else to go. So product is number 2. Number 3 is plans, because what's important is to have a view of the future and have a view of how you're going to get there. And that means creating the spreadsheets that can show you what money you're going to need, what people you're going to have to hire, what things will look like over the first couple of years, and so on. So, and of course, if we could turn the spreadsheet models we get into reality in the venture world, we'd be very, very wealthy. But we always take the spreadsheet that you give us and we double the expense side. We take the revenue side, we move it out 3 to 6 months and see how much money you're actually going to need, even if things go well. The Hofstadter's laws of programming say that every programming job takes twice as long as you expect. That's the first law. The second law is that the first law holds even when taken into account. So recursively. So you just have to be able to demonstrate to me that you can do some planning and that you can then modify those plans as circumstances on the ground change. I think it was Muhammad Ali who said basically all your plans for the fight go awry the first time you get punched in the face. You have to, everything changes, and that's what happens in a venture. You have great plans, and then something happens, and it could be anything. It could be COVID in the last year and a half. A lot of things we saw, it was COVID that took everybody's plans. And those people who could pivot, there were certain pivots that made companies do really well during the pandemic. And there are others that basically got shut down because they couldn't. So people, products, and plans. The fourth P is profits. In the long run, we want the company to be profitable. That's what we're in business for, is to make profits for the shareholders. We want to do well for the community. We want to do well for the employees, but we also want to make profits. And understanding that means really understanding unit economics. And one of the interesting things to me is that both Josh Koppelman, my partner who helped create First Round, and Eduardo Saverin, who helped create Facebook and B Capital, are both fanatic about unit economics, which is to say, for each individual item you sell, how much gross margin are you going to make on it? How many cents, dollars, whatever, are you going to make on that particular one? Because then if you get a large scale, you multiply that, and then you get enough money to cover your fixed costs, and you can start making big profits. But if you don't understand your unit economics, or if you think you're going to make it up in volume if you lose money on each one, that doesn't happen. So really understanding your unit economics, really understanding how the profitability is going to come is very important. So the people, the products, the plans, and the profits are the first four, and they're very important. Number 5 is equally important because it determines whether or not you're going to be able to raise money and hire people and get suppliers to work with you, and that's passion. How much passion do you have for what you're doing? And are you going to be able to transmit that passion to others? Can you tell your story in a passionate way that people see you're excited about what you're doing? You're going to make, you want to change the world with what you're doing, and you want to get other people to help you change that world. And that's how you get customers. That's how you get investors. That's how you get suppliers to give you credit when they really shouldn't. And that's how you become successful. So people, products, plans, profits, and passion. But not everything goes smoothly. And so the final P is persistence. Are you able to persist when there are problems? When you're working 24/7 and your significant other says, "I need you home," you got to this whole thing about work-life balance, which is something that we do need in life. But if you're a young entrepreneur and you're starting to build a company, sometimes that gets thrown out of whack for a couple of years. Do you have the persistence when the big customer contract that you were certain was going to sign by next Monday now gets delayed by another 3 months? Do you have the persistence to hang in there when the absolutely ideal CTO that you hired, that was your buddy from childhood, quits because he or she can't stand the uncertainty of the startup world? So those are the 6 Ps: people, products, plans, profits, passion, and persistence. And I look at all of those when I'm evaluating the entrepreneur, when I'm evaluating the story, when I'm evaluating whether or not I want to invest in a company. And that has led to some great successes and some great failures. We were the seed investors in a company that became called Fab.com, which was a rocket ship growth e-commerce company in the mid 2010s, and crashed to earth because it spent way too much, way too fast. We didn't focus on the unit economics enough. We let the founder try to build out Europe way before he was ready to do it, and it crashed. However, I backed that same founder in another company recently in the gymnastics type classes at home called Moxie, and it's doing quite well. So he's learned some lessons from that one, and he does know how to build a company. He does know how to inspire people. He has the passion. He has the persistence, and so failure in the startup world is not, in the U.S. at least, is not a lifetime thing. Many of our best founders have had a failure somewhere along the way. So that's kind of what I'm looking for and what I'm trying to do. And we are investing pretty consistently between B Capital Group and my family office in companies. Doing a lot of work lately in longevity. At my age, I want to live a lot longer. As Stephen Wright says, my plan is to be immortal. So far, so good. But I know that in order to get another 10 or 20 or 30 years out of this world, I've got to do certain things, in diet and exercise and sleep, in various interventions, medical interventions, all of which can essentially help me do interesting things, including reversing aging. Reversing aging is definitely possible. We've now seen it in lots of animal models. I mean, I'm not going to be 20 again, but I don't have to age nearly as fast as my calendar tells me. And there's lots of interesting technologies being invented, medical technologies, and statistics, just looking at data and genomics, obviously, the genome, that are helping in that. So that's an exciting area. What we've seen during the pandemic is telehealth has exploded. Obviously, home delivery has also exploded because people realize that it is easier to sit at home particularly if you're forced to, and get things delivered to you. Lots of interesting things there. And then another world that's continuing to astound is the gaming world. Virtual reality, augmented reality, new types of games of all kinds, all being very explosive and with extremely large markets. You know, in the 90s, when we used to ask people, what's the largest software company in the Seattle area? And most people would say, oh, Microsoft. And the answer was no, it was Nintendo, which actually had more revenues than Microsoft until the mid 90s and was based out in the Seattle area. Today, the gaming industry is far and away bigger than the film industry and the TV industry. And with esports growing even faster. So there are lots of interesting things happening in the gaming industry. And of course, we've seen FanDuel and those things grow as states and others legalize various kinds of gambling, which is mostly legal outside the US in other countries. So that's another exciting area. And then, you know, there's always people reinventing e-commerce. A number of you have talked about some of the things you're working on, which kind of fit in that. So that's kind of what I'm doing. Bonnie, any other questions?
Oh, thank you. I'm going to open it up to the audience to see who might have a question. Don't be shy. Feel free to ask away.
Howard, I thought it was really interesting that you said that number one was the size of the market. And I thought the reasoning behind it was insightful, right? Because pivots are almost inevitable, right? And so that made a ton of sense to me. But it's kind of counter to the way that I thought about things, which is like, you know, the thesis was the most important. And I guess I'd just love to hear like how you've kind of learned that lesson over time, like what maybe some of the startups or stories around that have really like elucidated that learning for you.
Well, I think we worked in the area of displays, you know, early display technology, and we found that people honed in on a particular technology in those early displays, and they had great software to make the displays do windowing and all sorts of things really fast, but they were focused on one technology, and when that technology didn't pan out, they were able to then pivot and use a different technology with the same software and get where they wanted to go. Whereas if they had not had that software and that big a market, they couldn't pivot. There was just no place to pivot to. We saw that in ModCloth, which was successful, but not as successful as we thought it would have been, which allowed people to crowdsource their designs for dresses and things like that. But we reached a sort of market size limit on that, which was much lower than we had expected, and ended up having to sell it to, I guess it was Walmart at the time, but when they were doing Walmart.com. It is true that the thesis is important, obviously, but that the thesis into a very large market is better than a thesis into a very niche market. And we looked at a number of things in the golf area, for example. You know, and golf is a very popular sport, but it's just really hard to get to that very large chunk in the golf area. We've done a couple of things in the pets area, which is bigger. It's a $65 billion business in the US. And there we've had some success, but, you know, modest, I would say, because, you know, the pets area very quickly becomes dogs, cats, birds, you know, and other, if you will. And so if you have something that's only one of those pets, you're in a much more niche market than you thought when you just said pets.
Howard, if I could ask a question in terms of, when you're looking at the TAM for a company, what is considered to be, a market size that you would deem acceptable, or if VCs in general would kind of look at and say, I mentor some younger startups, and sometimes they come with a TAM that's much smaller. But I think it'd be good for some of the folks here to kind of hear what a perspective range of an expectation would be.
Yeah. Well, there's two things. There's kind of the TAM, and there's sort of what you think you can actually achieve of that TAM. But we like to see TAMs that are in the 10, 20 billion plus range, because if you have 20 to 30 billion dollar TAM, and you can achieve a couple of % of it, you can get yourself into a company that's selling hundreds of millions of dollars a year, and then you'll go into adjacent spaces and other things that'll get you a very large business. Most venture capitalists used to say we want a business that can get to 100 million in revenue. Today, that number is probably more like 200 or 300 million in revenue. And so if you want to get to 300 million in revenue, you're not likely to very quickly get to 10% of a market. So that means you need to have at least 10, 20 billion dollars of available market to be really interesting. That's kind of the scale.
Thank you.
Anybody else have a question?
Howard, it's Trip. I had a question about the people part of this. When you look at an organization and evaluate the first leader, how do you help them find their complement? Because a lot of times you'll find a company with a great founder, but there's nothing behind it with other additional leaders that can support them growing, because that's what you're really buying. Can you share a little bit about how you look at the team and evaluate?
Yeah. So I mean, one of the things, if you Google first round 10-year study, you'll find that, as we did a study after 10 years at first round, that the most successful companies had two co-founders, and actually the most successful companies had a female co-founder, somewhere in the C-suite there. It is very important when we evaluate, if we see a solo founder who doesn't have a co-founder, we encourage them first to find a co-founder, whether if they're on the marketing side, find a technical person, or vice versa, who they trust enough that person can say no to them. The danger is a solo founder who has a high ego and conviction, which you need to have to be a solo founder. So it's not a bad thing, but you have to be able to listen to some other people. Are you, the industry term is coachable? Are you a coachable founder that we can say things to, and you'll actually listen to some of them? Finding co-founders, co-founder dating is something First Round has created a couple of methods to do. They hold occasional meetups for co-founder dating is what they call it. It is not an easy thing to do, but occasionally it happens. We had a hackathon in Brooklyn a number of years back, in which a marketing guy found his technical guy, and the two of them created GroupMe, which ended up getting sold to I guess it was to Skype very quickly for $80 million within less than a year. It was a great thing. And then they tried another company together, which worked a little bit, and then they split and each did their own company. And both of the new companies are doing well, but they each found other co-founders for their newer companies. So, but they got together just meeting on a weekend at a hackathon. So having a co-founder is important, and we do try to encourage it and help it along. It's not an easy thing. You need somebody who's open to having a co-founder. And again, part of that is about your passion and being able to bring somebody along. In the theater and movies, you got to get your audience along for the ride in that first 20 minutes, so that the willing suspension of disbelief sets in. And even though they know that whatever they're seeing in this movie isn't real and couldn't possibly be real, they'll go along with it. And a great founder has that passion and can get a co-founder in that first couple of minutes to go along with them on that ride. And that's what's needed. But you're right. Certainly, companies with a co-founder, with a co-founding team, two people at least, generally two and not many more, have the best chance of success.
Thank you. That's a great answer. Thank you very much.
Sure.
Next question.
Have you guys seen any artificial intelligence tools allowing for good match between founder and investor?
There are a number of artificial intelligence tools and search tools to try to match investors and founders. I don't know that there's any particular one that I could name. I know that some companies like 645, some venture funds like 645 Ventures has an AI tool that they use, that they scrape all the information they can get about startups and decide on an AI basis which ones might fit them best. And they've been using that very successfully. One or two of the other big funds do that. AI is a very broad term. So it's a lot of the pattern matching is much simpler than AI. It's much more simple vector mathematics in terms of saying, here's a set of attributes that we're interested in, and here's how these founders rank on those, and what are the highest numbers on that, as opposed to sort of a deep learning network for what's going to work or not work. There is a company called Correlation Ventures, a fund that only invests based on who the co-investors are, and not who the co-investing fund is, but who the co-investing partner is. And they have an AI model that says these partners in this area. So Robert Mittendorf in healthcare, I would co-invest with him in anything he does. Or Karen Page in marketing technology startups, I would co-invest with her in anything she does. So there are some tools like that, but so nothing specific to name.
Thank you.
Howard, it's Tripp again. To follow up on that, would you share how you would look if you were a founder, how you would evaluate an investor? Because an investor is forever. So how do you do this to pick the right investor, right? Would you mind sharing a little insights?
Well, I mean, one of the keys is to do the same thing that we do. So what do we do as investors? We go on your LinkedIn profile and we see who we're connected with that's connected to you, whether hopefully first level or maybe second level. And then we go get off books references. You've got to go and talk to people who work with that venture capital firm and partner and say, how were they? And particularly, how were they in the tough times? Not how were they, when everything was going well, but what did they do at the first time you missed a number, you missed your quarter? What did they do the first time that you lost some big sales, or that your technical team didn't deliver on time? And so you should do reference checking on the venture funds. Absolutely, there's no question about it. That's the best thing to do. I've certainly look up their track records and successes. That's pretty openly available for most firms. But also do the LinkedIn, say, who else do I know that knows Howard Morgan, and give Bonnie a call and say, what do you think? And or whoever else you find in that mix. Because that's what we do. I mean, we'll take the references you give us, they're important, but we'll also find off books references.
Thank you.
Great question too. Next question.
Hi Howard, it's Fiona from Australia. Just interested to get your view on investing in businesses or startups outside of the US ecosystem, because we know it happens, but I've been speaking to a few people and have different views around the things you need to do if you're a startup that's outside of the US.
Well, in February 2020, we were in Sydney and Melbourne looking at startups, among other things. And then Tom Hanks and his wife said they got COVID, and we were supposed to go to Singapore, and we couldn't go to Singapore at that point, unfortunately. Right. Certainly, there's some great and very gigantic Atlassian and so on that come out of Australia, for example. I think that the biggest issue with us, and of course at B Capital, because we're in Singapore and we do invest, and we have done Australia, is we want to feel that we're helping the company with more than just money. And if it's in Australia, sometimes that's hard. For a US-based venture fund, it's very hard. For a Southeast Asia-based, it's a little bit easier. But you still want to be able to provide help to companies, and that help is a bit harder if you're focused in Oz. And also, if you're down there, you've got to see how quickly you globalize your market, because you've got 28 million people, whatever the current number is in Australia. So you have to get to much bigger markets. But that's the same problem that Israeli startups have, and they've solved it by, pretty early in their careers, they usually put somebody in the States or in Europe as their marketing person, and that's pretty much what you have to do. But I think it's clearly harder. There are a bunch of Australian venture firms now, and some of them starting to do earlier stage stuff, certainly in Sydney and Melbourne, and a little bit in a couple of other key cities. Adelaide has and Brisbane have them as well.
Awesome, thank you.
I have a question. I think it's really interesting what you just said about wanting to provide more than just a check, wanting to be like helpful and strategic. And when you think about some of your sort of success stories or what you're excited about, what does that help look like to you when you're joining as an investor?
Well, today with B Capital, we're partnered with the Boston Consulting Group, as I mentioned. So every startup gets a BCG partner as a technology startup advisor. They meet with the companies once a month. They provide advice on things. So if you're in enterprise software, BCG has the experts in enterprise software pricing. You may be leaving a lot of money on the table. So they meet with them and they tell them about that. They tell them about how to structure marketing and sales compensation. Nobody ever gets it right. You have to keep changing it to keep reinventing the sales force. They've been experts at how to do that and how often to change and what to do. They help in those areas. We all help in hiring. We have big Rolodexes and try to find the right people to help and to give you in terms of growing the company. At the first round networked lots of founders. And one of the great things we did was for CTOs. So if you're the chief technical officer of a 6-person company, you don't have a peer group. What first round gave you was the CTO peer groups. You had 200 CTOs and you would ask a question of that group and you get an answer in 20 minutes from 4 other CTOs who had the same problem you do, but they had it 3 months ago and they solved it. And here are 3 solutions or 4 solutions. So those are ways in which we've helped, I think, very effectively helped lots of companies. And obviously the other place is in capital formation, which is to say, where should you go raise your next round? Who are our friends that like this particular area that don't have a competitor? And so we can sort of narrowly focus the fundraising effort as opposed to seeing 100 firms, we can take you to 20 where there's a much higher likelihood of success. So those are some of the kind of things we do.
Next question.
Howard, could you talk a little bit more about the unit economics and how you see that breaking down?
Well, so if you have obviously if it's a hardware product, you have to charge more than the hardware costs, and you may have to do that if you're a subscription business. You may do that over some time period, and you've got to look at trying to estimate what's the average customer lifespan. Typically, we don't really accept anything over 2 or 3 years, even though some businesses do have lifetime customers. But how much are you going to make for each individual sale? How much are you going to make for each? If it's a SaaS business, what is your customer acquisition cost versus that lifetime value? So if it costs you $300 to get a customer and they're paying you $50 a month, that's great if they last more than 6 months. But if they only last 4 months, then you're losing money in those unit economics. And those are the things we really try to look at. We really prefer an under 1 year payback for customer acquisition. And hopefully the economics, if it's a pure software business, are sort of 80% gross margins. You may have costs for web servers and databases and technical people and so on, but still, relatively speaking, high gross margin businesses. If it's hardware, we want gross margins above 50%, so that there's enough to cover it, so that you don't have to be in business for 3 or 4 years. You don't have to have 100 million or 200 million customers to break even. We'd like you to be able to break even at much lower customer counts in general.
Can I ask a question?
Sure.
Thank you, Howard. My question is regarding, I'm building a social app. And I have 2 questions that kind of follow each other. The first one is, what would you expect as an objective or as a goal from a company that does social in order to to feel comfortable investing seed? And the second one is also like, how do you see the process when it comes to timing? How long do you think, for example, I should approach your VC prior to my deadline of investment? how do you see the process of building the relationship?
Yeah, well, first of all, so in social media type things, and I would say that B Capital is focused on B2B, so we're not doing social media in general, but at first round, when we looked at social media, we wanted to see very high month-over-month growth. So we wanted to see user growth in the 80% month-over-month. Maybe after you got to a couple of million users, it slows down to 30 or 40, 50%, but very high month-over-month growth. Is there some kind of a viral spread? Because if it's a social media app and it doesn't have a viral spread, it's not going to be great. It typically takes three or 4 months at least to get a fundraise. It could take much longer, but if things are going well, you can do it in a couple of months. But you want to get people to know you a little bit. Most funds want to know you for a couple of months before they'll actually write the check. There's a lot of funds now, seed funds in Israel, for example, that are writing these kind of checks, but they want to know you a little bit, and but they also are looking for certain metrics in terms of what you're doing, which is to say very high virality, very high growth in what you're doing, and then eventually looking at also what is it costing you to get the next user, and then finally what is the revenue model. I mean, in 99, 2000, before that bubble burst, all we cared about was eyeballs. How many users did you have? And then we realized you actually had to make money off of each of them, and that you needed a plan for that. So nowadays people are much more serious about understanding the revenue plan if you're a social media app. And some of it is advertising, obviously, directly, but some of it may be other things. Maybe product placement. It may be product sales. Like on Instagram, a lot of the money is now coming from product sales, and so on. But it takes I would allow 3 to 6 months. And so I would start reaching out to venture capitalists soon or now, and with the expectation that if you're reaching out to them now at the beginning of June, that you would have a round that could close this year, maybe in October, November.
Okay, and would you say that obviously there is a priority to warm to introductions and all that, but would you say that also cold emails are in your experience are kind of the thing that you're going to look into?
No, cold emails don't work. I mean, just to be frank, and we've told this to everyone at first round and everywhere else. I mean, we feel two things. One is when we looked at all the investments we made, we only had 1 out of 500 investments that didn't come from a warm introduction, and it came from an office hours thing that we held where we would meet in different cities with different groups. But and then we stopped doing them because it was just the yield was too low to spend our time doing it. And we feel that if you're a scrappy entrepreneur and you want an introduction to Howard Morgan, there's a lot of ways to find out people who know me. LinkedIn is the one I mentioned earlier, right? And find one of those people and convince them that it's worth their reputational credit to give me a call or forward an email from you and say, I've got this interesting guy, he's doing this interesting thing, you should talk to him. Because if I get that kind of an email, then I usually will take a meeting or take at least a 15-minute phone call or Zoom in today's world. But if it's just a cold email, the odds are close to zero.
Thank you.
Sure.
So you mentioned your family office as well. What do you look at when you're investing out of your family?
Well, that's so most of that, because I don't want to compete with my funds. Most of that is in quant strategy, hedge fund strategies, things like that. There are occasional ventures that are in deep technology, in deep brain stimulation things, for example, things that wouldn't naturally fit into the B Capital world or the first round world. That's what we do in the family office. I have a company in Israel called Genetica Plus in Jerusalem that takes your nerve cells, grows them, tries medicines for depression to see how your particular nerve cells react to those depression medicines, and can tell you in a couple of weeks, gee, this medicine will work for you, this one won't. And it's a giant problem in the medical profession. They prescribe things for depression and it doesn't work. Then they prescribe something else, that doesn't work. Finally, after 3 or 4 tries, they get the right medicine for you. It might take a year, but we can reduce that to a couple of weeks by actually seeing which ones affect your particular neurons. So, that's kind of out there technology using stem cells and other things. So those are the kind of things that I look at. Some space things. I'm invested in the zero gravity company that does zero gravity flights, which I've done a whole bunch of with my kids and grandkids. So things that are a little bit out there.
Howard, when you think about the size of the market being the #1 most important factor, how do you sort of weigh today versus, an area that you feel like has 2 or 3 decades of, CAGR ahead of it?
Oh, we're quite happy to project out if it's really a greenfield market that no one's been in, and we believe it. That's fine, because the CAGR, if we see that growth is there. But if it's a market that already exists, then we want to know that it's a giant one.
Yeah. So space, is that a good example of that? Space
is a good example. The EV battery, the whole energy complex stuff is a good example of that. B Capital does not invest there. I've invested there through Idealab mostly. Space is one where I have done a small amount of investing. It's a longer time horizon than venture. Remember, most venture funds have a 10-year life, and maybe it's 12 in some cases, but it gets extended. But a lot of the space stuff, which we invested in 2001 and 2 and so on, it's 20 years, and they're still just coming into their own. And so they're not as good a fit for venture capital as they are for family offices that can have a much longer holding period.
Makes a ton of sense.
Yeah.
Hi, Howard. Oh, sorry. Go ahead, Juan.
Yeah. No, go ahead. So.
Oh, I was just going to ask. My company is based in India, and I'd love to hear more about your time and focus on the Southeast Asia market. You've mentioned some of the successes, but I'd love to know more about your experience there, and just in general, perhaps even some of the failures you've seen out of there. I'd love to know more.
Well, we have I guess 25 people in Singapore, Bangalore, and Delhi who are investing there at all stages. So we invested in a company called Bounce, which is scooters based in Bangalore. It's kind of like an Uber but for scooters, which was doing great until the pandemic hit and nobody could go anywhere. It's had a very rough year. Hopefully it will start to come back in that. I think what we found is that the markets are big, but you have to really understand each one separately. So Singapore is different than Vietnam, is different than Thailand from a regulatory point of view, if there's any regulation stuff. In Ninja Van, the delivery company I mentioned, we started out in Singapore and Vietnam, and Thailand. We really wanted Indonesia because that's the biggest market really outside of India. And it took us quite a while to get the foothold in Indonesia. We finally have it, and now we have the largest market share there. But you have to have a lot of local knowledge in the various local countries. In India, we did some of the large ed tech companies, Baiju, and we found that there's much more investment dollars in India at the late stage than there are at the early stage. So the early stage is just starting to pick up, and we're starting to see things like Arca, ARKA, some incubators starting. Sequoia has Sequoia Surge. They have programs for the early stage in India that have just really started in the last couple of years, mostly in Bangalore, a little bit in Mumbai and Delhi. Everybody felt that when Modi came in, there was pro-business and all sorts of digital things happened that were great, giving a billion people digital identities and access to banking and so on, all helped. But it still not as easy to start a business in India as it is in other parts of both Southeast Asia and certainly in the US and Western Europe. So you have to look hard. The other thing is it's dominated by the graduates of the IITs and a couple of the top universities, and so there's a kind of mafia of those groups that dominate a lot of the startups. So you have to be connected into those groups to have a better chance of success.
I have
sorry, George. Yep.
I'm sorry. I've been in tech a while. Obviously not. I wasn't using ARPANET, but Gopher was my first protocol. But I'm curious where you see, we're B2B SaaS, but I'm curious where the kind of hot areas that you're looking at right now in B2B are in terms of tech. Obviously the security stuff, SolarWinds, blah, 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 fear, the whole stampede.
Well,
but I'm curious just in general,
sure.
especially with the long view.
Yeah, well, certainly security, there's no question. I mean, we've done a couple of investments in security. We just doing one called Satori in Israel, data security operations. Israel has obviously been a place that's spun off a huge number of security related companies in all sorts of areas, security, privacy. We see a lot of things in sort of taking on or adding on to Salesforce. Marketing and sales, SaaS is still huge. Things that help with, somebody mentioned customer success earlier, things that help with customer success, very, very important. We're seeing lots of SaaS things there that we think are important. We think the biggest area right now is fintech. Fintech is just changing all over the world. And we're seeing fintech in India, fintech in Singapore and China, in Brazil with the new neobanks, of course, all sorts of things in the US. First round originally did OnDeck, which was one of the first lending platforms. Lending now there's so many different ways you can borrow. There's, and so many different big niches there. We just did one called Percent at B Capital, an early stage. That's a two-sided marketplace for debt placements for small debt. It allows family offices that want to own debt to match with people who are issuing debt. So those are very big areas. But look, Jamie Dimon at Citibank said about a year or two ago, somebody said, "What's your budget for security?" He said, "It's unlimited." He said, "Because I don't want somebody to say to me, you got hacked, and it would have been okay because I told you to buy this. I told you to buy George's product, but you didn't buy it." And he said, I just don't want that. So they come to me with a new security product that they think they need. We have to fund it. So they're spending billions a year on various security, privacy related things. And privacy is another big one. I mean, separate from security. And Apple has sort of led there the reason Apple has been so focused on privacy for the last decade is if you can imagine Tim Cook growing up gay in Kentucky, and where privacy just was very visceral to him, keeping things private, keeping his activity online private. And he realized he lived that as a kid, and he's trying to make sure that the world doesn't have to live in fear of that anymore. And so I think it's very, very at the core of what Apple is doing now in terms of everything they're doing to make things more and more private. And so that's another huge area. And then we at B Capital, one of our key theses is that in the industrialization, the digitalization of the industrial world is there. And so a big area for us in the future, we've just started investing, is agricultural technology, ag tech, because we have to feed 10 billion people in the next couple of decades. And that's going to happen with really some great, really ag tech. We just saw 5 different startups based out of Israel that are in the beekeeping space that automate beekeeping in some way, because we have this big problem of colony collapse disorder where bees are dying and we don't have enough bees to pollinate all the crops we need. So there are startups that are figured out ways to either protect the bees, to create artificial bees, all sorts of different riffs on how to make the beekeeping world a better and a more interesting world. So lots of interesting things going on. Mike, did you?
Yeah, I was just wondering about, advisory. So, I believe advisory is a very important part of a puzzle, especially during growth. But I'd love to hear your take on how a company should approach advisory and bring those people into the mix.
You mean what kind of advice to put on your board or on advisory boards and things like that? Or
yeah, advisory board, basically starting to set up your first advisory board or bringing outside expertise into the mix.
I think it's very helpful. I mean, having a stellar board of advisors gives you a credibility with customers that you might not just have on your own. If it's an ed tech, you want top educators, educational leaders, and so on. If it's in anything in the healthcare, you want the right medical advisory board and scientific advisory boards. Little less clear in the sort of marketing tech world and so on. But having advisors who've done it before, who have the contacts to connect you into large corporations, all very good. Typically, you're going to give them 0.25% to 0.5% stock option grant over a couple of years for it. Some of them will want to invest. More and more nowadays want to invest. That's all well and good. If you're in the consumer space, you might want to hook up another fund that I advise. It's called Plus Capital, based in Los Angeles. And the plus for them is celebrities. So they will bring celebrities who are appropriate to your product, who will put money in as well, plus their time and name. And so they have stars like, you know, Scarlett Johansson and Tyra Banks and a bunch of sports figures and so on, who all are part of the fund, but also, you know, work with the companies. And those kind of advisors, if you're in the consumer business, the influencers in general can be very important and can give you a quick push on things. Somebody said the Kardashians now charge $1 million for a tweet to promote your product.
Yeah, it's 10,000.
Yeah, I know.
Yeah.
It used to be nothing.
So next question.
Yeah, Howard. You've mentioned about trust and building trust, and you know the 6 Ps kind of lead up to that, and a lot of other things as well that you mentioned. From your experience, what are some things that you've come across that have been kind of like eyebrow raises in terms of that that may be on the distrust side, and then on the flip side, what are some things that you've been pleasantly surprised with that people have done to really kind of solidify that trust?
Well, as I said, the first thing is tell me the bad news first, right? I mean, I say there's one of the things that really helps build trust is when you come and say, you know, we lost this contract. I'm really distressed, but here's why we lost it. Here's why I think we lost it, or here's why it's gotten pushed out a couple of months, whatever. And I don't wait for the next board meeting to tell me about it. You know, tell me about it when it happens. That's key. Second thing in trust is talking sort of openly, with, you know, one-on-one about issues and problems you're having internally in terms of staff and so on. You know, I can't work. This person's making it hard for me to work with. They're undermining me. They're flaunting my authority. Whatever it is, but sort of early, rather than coming as I got to fire him. And I say, well, there was no warning. What's going on? And you know, if it's something like if it's been something that's been building over months, you know, try to have a discussion about it earlier. That helps to build trust. Look, I mean, I've been fortunate to have very limited instances of true fraud in companies. It does happen, however, you know, and we were not investors in Theranos, but that was one where there was just no information flow, and you know, it just there was no willingness on Elizabeth Holmes' part to bring knowledgeable people in. So all of the healthcare investors who looked at Theranos passed. They got investors who were not in the healthcare field, and therefore nobody had any knowledge about what was going on. So you know, one of the things that builds trust is to be able to have really knowledgeable advisors around, whether it's on the board or advisory board or whatever, that can keep everyone honest in a sense. That's, you know.
Awesome. Thank you.
Next question.
I'll hop in with one. Howard, I saw that First Round Capital has a few investment in the creator economy or passion economy, Splice and Gumroad, et cetera. I'd love to hear a bit about how you think about that space and where you see the big opportunities.
Well, at B Capital, we have one we can't announce yet, but a Brooklyn-based company in that space. We think look, there's the creator economy and there's the freelance economy and gig worker economy in general. We think that the creator economy part of that gig worker world is the more interesting one because the dollars are much bigger. I mean, the creators are not getting minimum wage when they create; they're usually getting much more. And there's all sorts of things they need to help manage their lives, and we think that that's important. And some of them involve getting jobs. Some of them involve how do you bill for the jobs? How do you collect? When do you collect? All sorts of stuff like that. So we think those are all interesting areas. We think creating networks of the creators is very interesting, where they can both help one another and because there are some jobs that are too big for one person. So lots of things like that. What you said I made a note to say to take another look and just maybe connect you with this other company of ours that we're working with, but not announced yet, because that we think it's a very big area in the future. There have been a lot of things for the Uber drivers, for the Lyft drivers, for the DoorDash delivery folks, and I think there'll be a lot more for the people who are doing content creation, the writers and so on, the artists who are doing stuff in the ad tech world, obviously. So those are all important.
Yeah, for sure. No, I'd be happy to connect with you
Yeah.
and whoever you think would be a good fit. Awesome. Thanks.
Sure.
Speaking of which, I didn't know if you wanted to share your email or if you want me to send it to the attendees.
I'll put it in the chat here. 1 second.
Okay.
Here. I mean, the one thing, as we say, the one thing in the venture world, the sin is not in passing on what proves to be a great investment. The sin is in not having seen it, right? So yeah, we'd rather have seen it and passed than not have seen it. So we saw Airbnb, but both Josh and I realized that there was no way our wives would let somebody sleep on a couch in our house. So that was a stupid idea, obviously, and so we didn't invest in Airbnb. We have a lot of other examples of the same kind. We had invested in a company called Audio, which was in the podcasting space that Ev created, and then when Apple announced free podcast software, he said, "I'm going to give you the money back." He gave the money back. He said, "But you can all invest in my next venture, whatever it is." And he came to us with it, and it was called Twitter. But he had to set a pre-money price of over 20 million. And at that point, at first round, we said we wouldn't do over 10 million pre-money. This was in 2006. So we didn't invest in Twitter. Union Square decided they would keep the money in, and they invested in Twitter. When Jack came to us with Square at an even higher price, we said, "Okay, we'll do it." And we made sort of 25x on our Square investment. But you learn over time that. So therefore, my email is in the chat, and if you email me, just say that you were at Bonnie's breakfast, and I will at least read it. I can't promise anything more than that.
Howard, could you talk a little bit about the importance of smart money versus dumb money? Bonnie and I had a conversation on our cloud. So would you share a little bit of your insights to that and why people should be a little bit more selective?
Yeah, I mean, we're in a funny world today, right? Where there is so much money that we often just don't do deals because they've got a dumb money investor, somebody who's going in at a very high price. And there are two ways to make money in venture capital: to buy low and sell high, buy high and sell higher. And what we're seeing right now is a lot of the second. A lot of people coming in and saying, we just believe this bull market's going to go on forever, and so we can pay a lot because we'll be able to get out before it's over and sell higher. Having been in this for 40 plus years, the answer is no. I still want to buy something at the right price. Maybe I'll pay a little more. Maybe obviously the prices have gone up a little bit, but I'm not going to pay 2x or 3x. And it's very hard for an entrepreneur who's concerned appropriately about dilution if the discrepancies get too big. But if the discrepancies are small, sort of 10 or 20%, then you really want to take the smart money because the smart money, first of all, you're less likely to have a down round as your next round if you haven't gone way too high and you need more money. And secondly, the smart money is, as I pointed out, going to help you with a lot more than money. There's one fund out there which is doing a deal every 2 days, huge fund. They raised a $6 billion fund. They went through it in 9 months, and they've been very successful. And they raised $10 billion just recently, and they told their investors that this may only last us a year. And they're going into companies and they're saying, here's our offer, this much money, and usually 40 or 50% higher than anyone else has been offering. We don't want a board seat. We don't want to bother you. Just take the money. Well, that's pretty tempting to founders, right? And so they're getting a lot of deals that they're taking away from other people because they're willing to way overpay. We had one deal in the fintech world. We offered 450 million pre-money. We thought it was the right price for a C-stage fund company. They came in and offered $610 million. We reluctantly matched it. We said, we'll match it, 610. And the company called and said, nope, they came back at 650 plus a $200 million credit line. We accepted. Nothing you can do. Nothing you can do on our side except say there's a lot more companies out there that are looking for capital, and we find the right ones, and we'll do it at our price, and we'll be successful, and hopefully they'll be successful too. But from the company point of view, if you want help other than just cash, then smart money is worth something. It's not worth 100% delta. So, but so you got to be rational about it.
I have a quick question. Hey, Howard. Something I've always respected about yours and Eduardo's investment is that they sort of have this on the ground feel. And they sort of, because of that, they sort of seem to come out of all these niches that you don't necessarily expect to scale, which is fantastic, very unique. So I'm wondering, maybe this has something to do with your focus on unit economics, and if so, what are some other hallmarks of the team that go along with a functioning company that's investable with good unit economics?
That's an interesting question. I have to think about it for a second. I mean, I think
perhaps operationally.
Yeah, no, I understand. Well, it means there's somebody who really understands the numbers, right? I mean, there's nothing frustrates me more than asking the CEO how much cash is left, and they don't give you they don't know the answer, right? I mean, in a venture, in a startup, cash is king, right? How many weeks do you have left, or months, or whatever? And understand, having that be visceral, that really needing to understand that's the hallmark, and it sort of permeates the top team, except for the CTO probably, of operations and marketing and so on. They really understand how much money we've got, how much we need, how much we're generating with each sale. So that's kind of the hallmark of all that.
Right, a visceral focus.
Yeah, a visceral
awesome.
focus. Yep. What's that background? It's a lovely background.
Oh, this is the Florida birds saying hi.
Oh, okay.
Oh, my background? Oh, this is Dubai. This is my,
Oh,
I think
Dubai.
my friend was in Dubai during the pandemic, so.
Okay. Yeah, Dubai.
Thanks.
Yeah.
Oh, you're still
I saw the yeah.
Everyone went to Dubai when Europe closed, and then I guess everyone had to leave.
Yeah.
So.
Yeah. Okay.
So we might have time for one more question. I don't know if you have a hard stop at 11, Howard. I know you're.
I do, unfortunately, but yeah. Take one more.
Otherwise, I'm going to ask you about, unless somebody has a question, I'm going to ask you about dorm room funds, since Gen Z is very entrepreneurial, and I know that you all have had the dorm room fund for quite some time. So I'm wondering if you've seen a real uptick there.
Well, the dorm room fund was designed to do two things. The initially came out of a conversation when Peter Thiel started offering money to kids to drop out of Stanford, and we said, no, you really got to finish college, guys. I mean, the dialogue was like, okay, why are you dropping out? And they would say, well, Bill Gates dropped out, and Mark Zuckerberg dropped out, and Michael Dell dropped out. And we'd say, yeah, now name the next 30. And of course, it stops with those three pretty much, right? And so we say, you're much better off finishing. All the other founders we know actually finished. So how do we keep you in school? Well, we'll give you the venture experience and with the dorm room fund. Dorm room fund has been quite successful. We have a number of big markups. And what we've just recently spun the dorm room fund out of first round. Molly Fowler, who had been running it inside of first round, is running it outside of first round, so that it's now funded by a number of venture funds, I think 5 or 6 of them, and we'll expand to more campuses. And that's all in the process of getting announced. But it has been very successful in training a next generation, the Gen Z generation, both of venture capitalists, that is, the students make the decisions about it, and also creating really interesting companies that have had a great return. Fiscal Note is a unicorn now that came out of the dorm room fund. There are several others that have come out of there. Memora Health, which B Capital and First Round have both invested in. So it's been a great success and it's got a great student cohort. And this was set up to allow the students in colleges in the New York, Boston, Pennsylvania, and Bay Area, and now all over the country, during the pandemic particularly, to become venture capitalists and opine on fellow students' ventures, to invest typically $20,000 in those ventures to get them started, and then help them grow. So it's been great.
Thank you. I know you have a hard stop. Thank you so much.
thank you all. It's been great talking to you, and good luck with all of your ventures. I wish every one of them will succeed. I know it's unlikely, so because I've got statistics at minor, but I hope that you're the one who beats all the odds. Take care. Thank you.
Thank you.
Thank you.
Thank you.
Thank you very much. Thank you, Bonnie.
Thank you.
Thank you.
Howard.
Thanks, Bonnie.
Thank you.